The S&P 500 is nearly on the cusp of taking out its record high from 2 years ago. But my next guest says it's time to start buying the beaten down parts of the market. Let's dive in further with David Bahnsen. He's CIO of the Bahnsen Group. David, so far the market's in your mood the last couple of days, don't you think? Welcome.
Yes. Happy New Year, Kelly. It does seem as if the start of 2024 feels more like 2022 than 23. Of course, it's only a couple of days, but obviously those big momentum names in the NASDAQ are facing a valuation wall. They're just extremely expensive, and many names can execute really, really well from here and yet already have it priced in, where I do think some of the defensives in 2023 that were still up in many cases, some of the utility names may not have been, but they weren't up that much. They didn't get overstretched. I think 24 is going to produce some of those opportunities.
So before we kind of dive into those opportunities, does that mean the Magnificent Seven, that they're not part of your portfolio? Because even though I take everybody's point about the size of the companies and the performance this year, on a 2-year basis, it's not that spectacular. And on a PE basis, some of them are, 30x. It's not, crazy.
30x would be the cheap ones. I mean, some of them are 100x and 50x. I mean, as a group, they're 55x.
Wow.
Evenly weighted among the
seven.
Isn't
that Amazon,
right?
though, largely Amazon? Because even NVIDIA's at, 30, Microsoft 30, Apple probably, 20-something.
Yeah, I mean, again, some of it is if you're looking forward versus trailing, that makes a huge difference too. I think the idea with some of them is absurd that they can hold their margins and get some of the revenue growth that's projected. And so you have a lot of issues with that. But you make a great point about the 2-year view. You had such an incredible performance in 2023 for some of them. Let's take NVIDIA out. A lot of the rest of them are negative return or even returns. You recall like a group like Netflix, which isn't in the Magnificent Seven, but the old FANG nomenclature, It gave back 10 years of returns in 2022 in like 6 months. Wow. I mean, these things are capable of falling very quickly.
So, and perhaps you're kind of hinting we could see that happen again. I mean, certainly the places you're looking, do you expect big gains out of them, or are they just ways to stay defensive?
No, I mean, what it is for us is a permanent philosophy of investing, Kelly. I believed it in 22 as well. Dividend growth was up about 6 or 7% when the S&P was down 20. Dividend growth was not up as much as the market in 2023, but it still had a mid-teens performance, which most people would take any year. And on a 2-year basis is beating the S&P by over 10%. And so you made a really good point before the break. We're not back to our high with the S&P. As great as 2023 was, based on 22, investors still haven't got back to that level they were 2 years ago. That's the market I think we're going to be in for years. Big years up, a few years down, but range bound. And the problem, the reason I believe that is because of valuations. You just simply cannot get the earnings growth to get double-digit returns compounded for the next 10 years with a market starting at 20 times earnings.
But see, now you're making us nervous again because for the new year, we have to fund some 529s and things like that. And in the back of our mind, we're like, please let this not be the year that the market tops out for the next 5 or 10. But then, you'll feel like that might always be the case.
And one of the frustrations I have is that you want to make that consideration on a rational basis, not with the Fed hanging over your shoulder. And there's been this wall of when the Fed would stop tightening. Investors dealt with that all of 23, and they felt like they got that Powell pivot at the November meeting. And I most certainly agree with consensus that you're going to see rate cuts in 23. And I don't really care if it's 100 basis points or 200 basis points. It's going to likely be somewhere in between there. But fundamentally, you just have earnings projections that are really optimistic, and you're doing that at a starting point of a high valuation. I'm a child of the late 90s, early 2000s, beginning my professional investing career. I saw incredible companies that have performed magnificently for 25 years that never got back to those levels that they were. Cisco, Intel, some of those great examples,
right?
Because if people entered at too high a valuation, you just couldn't recover.